Welcome, everyone, to the Directed IRA podcast with Matt Sorensen and the incredible Mark J. Kohler.
Wow.
My spectacular co-host here today.
Thank you.
Yeah, welcome.
Wow,
welcome to all of you.
What? I got to up my game with that introduction. So
you better be incredible and spectacular.
Yeah. Okay. We can do it. Well, I'm excited about this topic. Matt Sorensen chose it. Matt's going to give you the touchy-feely title and introduction, and then I'll tell you the real introduction. So go ahead.
All right. Okay. Well, we're going to talk about solo 401ks today. This is an awesome account type many of you use that are listening to self-direct your retirement, to save and plan. And there's so many great things about it, but it is the most screwed up self-directed retirement account out there by far.
Which brings me to the hard-hitting title that I wanted to call, well, it was just too many words, this is a public service announcement, a BS alert, a debunking podcast of all the crap out there of yahoos selling what they call a QRP or a qualified retirement plan, or, 401k on steroids, or blah. They come up with all these stupid names when they're not lawyers, not accountants, and they're out trying to make a buck rather than go to school and get licensed. I'm pissed. You're right. And it makes me mad. And they sell people these solo 401ks that are with another unique name when it's really just a solo 401k. So if any of you have bought some sort of retirement account where you can put in more money than an IRA, and hopefully you have a small business, that's one of the screw ups here, and you get sold this and you roll money over to it, it's really 99.9% of the time a solo 401k. So we're going to break it down. Was that too hard hitting?
No, that's, we just got to get straight to the point. We don't got to sugarcoat it today. So let me talk about a solo K. So we're all on the same page about what it is.
Okay.
A solo 401k is a 401k plan that is adopted by a business for the benefit of employees or just one employee. So if you have a business, even if you're just a sole proprietorship with a store on Amazon, I don't care. You're a real estate agent, you're a doctor, you do consulting, whatever. You're self-employed. You got an LLC, an S Corp, sole proprietorship. You have a business. You can create a 401k for yourself that you can contribute a lot of money into. You can put over 60 grand a year into this. And if you got a spouse that's in the business, you can put 60 grand a year in for them. You can do Roth. You can self-direct it. There's so many awesome things about it that we love and that we set these up for clients every day. But it requires you have a small business.
Yes. Now, that sounds so simple. And it's true. On the face of it, it is simple. But we have people come to workshops or give us a call and go, hey, I've got a QRP and I don't think, and they have questions. And we go, oh, so you have a solo 401k? No, I just have a QRP. Oh my hell. Okay, well, do you have a small business? No, I'm just a W-2 employee. Well, you can't have a QRP if you're just a W-2 employee. We have workarounds if strategically implemented with proper tax and legal advice to keep you out of hot water. For example, I have what I call the side door 401k. We kind of have the backdoor Roth, but I love the side door 401k, where if you have a rental property business, we might set up a management company for your rental property business, which I would never normally do. Some bozo is going to try to set up a Nevada LLC for you to do that, which is a waste. But we might set up a management LLC to run your rentals so that you could adopt a 401k in the management business. You can't just have a solo 401k and a rental property LLC. You've got to have some sort of operational business. That's a side door 401k. And if you want to start driving Uber and set up you want to start some consulting on the side, we have options, but you got to get your head around the small business thing first.
Yeah. But if you have no self-employment, maybe you got a rental, maybe you got a W-2, your spouse doesn't have self-employment, you're not going to qualify for a solo 401k, QRP, whatever you want to call it. These are employer-based plans. Only an employer can adopt it and create it for the benefit of the employee.
Okay. And on the flip side, thanks, Matt, for letting me interject here. On the flip side, here's another not workable roadblock, is if you have employees.
Yeah.
You can't have a solo. Now, what does that mean? It's the laws are getting a little more stringent, but it generally means that you have a full-time employee that has been with you for at least a year. That's the general rule. Now, Matt, I think in the last Tax Act, it even got a little more stringent. It could be part-time employees that have been with you a
For
certain
3
longer
years.
period of time. What's the rule there?
Yeah. So part-time employees now, if you've had them 3 years, you must offer the 401k to them. And what we're saying here is if you have other employees, it's not a solo K anymore. See, the solo K is like a cool thing where it's like you can do it for yourself. There's all these rules you got to follow, this testing and filing and readily available investments and all this stuff you have to offer. When you have employees, if it's just you, the business owner, or a partner or spouse, that you can get away with not having to do this full-blown 401k stuff and all these complicated filings and letting people have notice when they qualify and all this. So if you have employees though, now you're jumping through all these hoops. Now you're not going to be putting 60 grand in a year. Now it's much more harder to self-direct. And so we're always trying to look at, well, do you have other employees or not?
And let me just emphasize the word solo. Okay. Let me repeat that. Solo, meaning you're the sole owner and the only employee generally, except for family. So spouse and kids, you can still get away with a solo, even with a partner, which is generally not going to work, but it's possible. See it rarely. Now, let's talk about, I guess, a workaround that people think is okay, but it's not. You say, well, I've got a business with employees. So, but I've got this other business over here. I'm selling on eBay. I've got an internet business, a consulting business, a little service business on the side. I'll set my solo up there in my real estate flips or whatever. But my main business, the restaurant, the dental office, the doctor's office, the engineering firm, whatever, well, I won't do the solo there then, guys. Okay, I get it. Thank you. I won't do the solo with the employees over here. I'll just do it over in this other business.
Doesn't work either. See, these are the landmines, and people start thinking logically and they start thinking of ways to get around a rule they hear, but they don't know there's a subpart to that rule that says, we thought about that. We're not letting you do that either. And so the 401k rules are actually quite complicated, more complicated than the IRA rules, because they're designed to protect employees from being taken advantage of and not getting the same benefits that the employer, the business owner, gets. So once you have employees, just know all these gymnastics you might try and do to try and get around the rules, it's not as easy as you think to pull off.
Yeah. Now, here in a moment, we're going to give you some common mistakes, but we're just literally, these are the common mistakes is right out of the gate. People thinking they can do what they're doing, or they don't know what they're doing. And so I guess this is the list we're starting, but
well, let me give an example. Like I was speaking just 2 weeks ago at a real estate event talking about IRAs, and someone said, well, how is this? Why wouldn't everyone just do a QRP instead? And I'm like, well, actually, because most people don't qualify for that. And I think when you say QRP, you're talking about a solo K, of course. And I'm like, so most people don't qualify for it. Well, why don't most people qualify for it? Well, they have to have a business. You have to have a legitimate, real business on your tax return somewhere that has some income. Well, I don't have that, and I have a QRP. I've seen this before many times.
Yeah, don't bend over for the soap, bud.
Yeah. So let me say, if you're in that scenario, what you need to do, you don't have a business. We're not going to make one out of thin air. Now, maybe there's the management strategy side door 401k for those you got rental properties, or something you can start to try and legitimize this. It's already jacked up in the past, though. I can't go back in time and fix it. Maybe some of you just need to close it out and roll to an IRA. And so there are some fix-its to try to do to get this resolved. The worst case scenario is you keep just doing the same thing over and over again and thinking it's okay.
Yeah. And here's a big solution here, everybody. I know that some of your blood pressure is going up. We've been hard hitting. Some of you feel like you're in hot water already. Take a breath. Okay. Now, this is why we have a 401k consultation service. It's literally a service that is a standard product, if you will, at our law firm. You can call the office and go, I need a solo 401k. I'm thinking about a solo 401k. I have, I think, a solo 401k or one of these QRPs. Can I meet with a lawyer and talk about my situation? And for less than $500, you can have that consult and figure out where to go next. If you say, oh, I want a 401k, we apply that hour towards the cost. We are setting up solo 401ks for $9.99. They're under $1,000, and you get a real tax lawyer with our letterhead backing up what we recommend. But the problem is these, I don't even know what to call them, are out on the web and saying, you need a QRP, and you call up, and they're not looking for reasons to protect you. They're looking for reasons to sell you. So they're going to just not ask the critical questions because oftentimes they don't even know the answers themselves. They don't know the loopholes or possible ways to structure it. They just go, oh, you want to roll over money? Great. Let's set this up for you. And they screw people over because they shouldn't be doing what the hell they're doing. So people hire a damn professional. And if you don't like our firm, fine. But don't go hire some bozo to set up a solo 401k QRP thing that's not licensed to do so. It's legal work. It is the unauthorized practice of law if they're trying to give you advice, and they shouldn't be. Woo!
There you go. All right. Okay. That was spectacular.
Thank you.
I promised it and you delivered. Thank you. Okay, well, let's get to a couple other things. There's a lot of other things I want to talk about on solo 401ks, because even if you had it set up right, even if you qualified and did it right, there's a number of things that people still nevertheless screw up. Okay. Now, what I always tell people that want to do a solo K, I'm like, all right, well, you got to know what you're doing. And here's a few things you got to know. Let's hit the first one. The plan has to be up to date. And I've got an article by this. You can go to it at kkslawyers.com, mattsorensen.com. I've got an updated article on this. The plan has to be updated at least every 6 years. And if you fail to do that, there are literally penalties. And I've helped clients try to negotiate these. We've had people come to us that get random audit on 401ks, which, by the way, there is a department that audits 401ks regularly. There's not a department that audits IRAs. So you could get audited on this stuff. But we've had clients come to us. I literally had a client with 2 years that they've penalized him over $30,000 in penalties. And this is just someone with a, small business, solo 401k guy. And so these penalties are for real. And I got the citation in there if you want to go look into it, and the penalties that the IRS charges on this. So get your documents up to date. If you set them up through us and you're on our plan, we're the custodian or on our compliance plan, we will update that. Our plan docs that are pre-approved with the IRS, we will automatically update them at least every 6 years, which is, again, required for your plan to be in compliance.
Okay, I'm making a list here for everybody. Let me bring us up to where we're at now. Number one, landmine, if we call them landmines. Number one is, did I really qualify for this 401k, whatever term someone calls it? And I think the big check marks are, do I have a small business, no employees, or no employees in an affiliated group? And that's where I was going earlier, where you say, well, I'm going to set up my solo in a different business, but I have employees over here. Yeah. If you're a majority owner of both businesses, it's as if it's one business for these rules. So do you have a business that's operational, not just rentals, and do you not have employees? That's probably number one screw up, is people didn't qualify in the first place. The second one, and Matt, you alluded to this, you said it, but I don't think we really unpacked it, was it set up properly? Now, for me, the number one thing on set up properly is, did the company name that is an operational business adopt the 401k? It just can't be your name. And so people set it up, but under a name of a business that doesn't even exist, I think. Or what are the other ones that you would highlight as not set up properly?
Yeah, the not set up properly, that would be it's called the adopting employer, the adopting entity. That's who's creating the 401k plan. If this is the Dunder Mifflin 401k plan, it's not Michael Scott. Okay. It's not David, what's his name? Oh, David. the boss, Michael Scott's
I
boss,
forgot.
David,
I forgot.
whatever. It's not him.
It's
Okay.
not Jan's. It's not Jan's.
No, it's not Jan. It is, it's not Robert California. I love James Spader, by the way. That was actually a part I kind of like James Spader in that. Anyways, it is Dunder Mifflin. That's the adopting employer. Now, Michael Scott may have an account in the 401k, just like Pam and Jim, right? Everybody has their individual account, but an employer adopts a 401k or any qualified retirement plan, right? These are employer adopted plans.
Okay. Now on the, was it set up properly? I think adopting company is one of the big ones. And number two, did you go out and set up a proper bank account for the 401k?
You're getting ahead of me. I got that already. That's
okay.
Got that on my list.
So that we'll come back to that one. So was it set up properly from the beginning? Then the third thing that we said was a landmine. Are you updating it regularly?
Yeah.
And then the penalties for not doing it. I wanted to just make one note too. If you set up a solo 401k and did have employees and you funded it for yourself and not those employees, we can't unwind that per se. I mean, it's ugly.
I've dealt with that one too. Okay. A client came to me, set up with another company, of course, who told him, oh, you have a property management company with 13 employees, but you have another entity you do your fix and flip properties in with no employees. Just put the solo K in that entity. You own them 100%. It's okay. It's a separate entity that doesn't have employees. You can do a solo K there. He got audited. This guy had over $1 million in his solo K, was doing awesome, flipping properties in it. Guess what the IRS made him do? They looked at his contributions and how he was matching it, and then look at how he put nothing in for those employees in that property management company. He had to go back and fund accounts for all of those people. I mean, he was maxing out for himself. It's not expensive, let me just say, okay? And that's going to be the rule. So if you've got employees and you're playing this game, that's going to be the penalty. The IRS is going to come down. They're going to make you throw in all this money for your employees now. Even former employees he had that weren't working for him anymore, that were at the time, he was dropping money in his 401k.
Okay, now let's digress for a moment, or side note. It's okay to have a 401k with employees.
Yeah.
We have one at our law firm and we self-direct it. We have referral sources to help you set up a group 401k. They're called a safe harbor. They're not the end of the world. You can still put in your maximum contribution for the year. It's the matching that's limited, because if you're going to have employees, the match for yourself has to be equal to the match for the employees. And that's where you're like, I don't want to do that.
Yeah.
But everybody can put in their contribution based on your age, and that's cool. And then the matching is limited. It's called a safe harbor. You only have to put in this safe amount up to a certain percentage, and then you're okay. They're okay. So don't think the sky's falling. We can, when you do your consult with us, we can say, hey, you're a great candidate for a safe harbor. You can still self-direct the hell out of it and buy real estate and crypto and small business. Just do it right. That's the side note. We have podcasts on that.
Yeah.
All right. So other landmines, I got the 3. Did I really qualify? Was it set up properly? And it needs to be updated.
Yep. Okay.
What would you say? Another one.
Let's hit number 3. Well, let's hit the next one. Sorry. What are you on the list? Are we on 4 now?
I just had, did I really qualify? Was it set up properly? And did I keep it updated?
Okay.
On the setup properly, the sub one was adopting company. Do you want to mention bank account there?
Yeah, let's go to, this is a new one. Let's go to, are you properly tracking your funds? Okay. So the IRS requires that you separately track and manage funds in the solo K. So for example, if you're doing Roth dollars and traditional dollars, and you got a spouse doing Roth dollars and traditional dollars in the solo K, which you can do, it's awesome. You've got 4 accounts. You're going to have 4 different bank accounts with those funds being tracked separately. When you invest those accounts, you're going to be investing them separately and tracking them separately, because you got to know when your Roth 401k makes money, that the profits are going back into that versus your spouse's traditional account when it makes money, and that the proper funds getting traced back to that. So you have to track these funds properly. It starts with having separate bank accounts at a minimum to track these funds.
And I think I can say, it's really 2 points, really. When you set up the 401k, you need to set up the proper banking and accounting software or have a service. We have a service to do that for you. Some clients are like, nah, I'll do it myself. Cool, knock yourself out. So we do have account support services. But then really, I think step 2, which is that second issue, is even if we have clients that set it up properly in the bank account and then they don't do anything.
Yeah.
And so you've got to be on top of this. The beauty of the solo K and the drawback of the solo K is you're the solo, you're in charge. You've got to make sure it's cheap to set up and per se and cheap to maintain. But if you don't do it, it's a train wreck. So you got to be willing to buck up and pay someone or do it yourself.
Yeah. Okay.
Now, if I'm properly tracking, I think there's a tax return in here somewhere. I have a feeling, Matt Sorensen.
Okay. Yes. Now, the next thing, and this is very timely right now. This is June of 2022. We're doing this right now. There is a tax return required once you have 250,000 of value in the 401k. This is adding up all the value of the investments, the cash in the account. You know, if you got spouse in there, this is all accounts combined. If it's greater than 250,000, you have to be filing a tax return for the 401k called the 5500 EZ. Okay. This is filed that it's due July 31st for the prior year. So right now we're doing them for clients that had 250 grand or more. So at Directed IRA, if you have a custodial account for a Directed Trust Company for your solo K, we automatically just file it for you. We know your values. We're custodying your solo 401k. We're doing it that way. For those of you that self-trustee it and have your own bank accounts or brokerage accounts that you just want to be in control, cool. Come to the law firm. We have a service and we can just do it a la carte for you as needed. It's $250 to do your 5,500 easy.
Now, when do I have to do a full 5,500?
So if you have employees, so once you get employees, it's not a solo K anymore. It changes over and you're doing a full 5,500.
And if I have less than 250 grand and no employees, there's no tax return required.
Right. There's not, the IRS doesn't want to know anything yet. They're like,
you're not still get audited.
We don't care. Yeah, you could still get audited, but they don't really care yet. So once you hit 250 though, they care.
I want to go back to setting up properly, Matt, and ask about the EIN, the tax identification number, because we have clients that say, oh, I set up my solo 401k, and then they walk into the bank and go, I need a bank account for my 401k.
Yeah.
That's when their brains explode. There's some key verbiage we recommend people use when they go through that. And EIN, do you want to mention that?
Yeah. So our recommendation is always use banks that actually have solo 401k bank checking accounts. And there's a number of them we recommend, and we give you those resources, of course, when you're setting up with us, and they know what the heck you need and can walk you through it and just set that up. If you walk into the bank, if you're walking into just Chase Bank that you go into for your regular personal or business banking, and you say, I need a solo 401k bank account, you're going to blow their brains. They don't know what you're talking about. Okay. They don't have a product for it typically. And so they're going to push you into some other account type, which can be fine. You could have just a separate, it could be classified as a business checking account or a trust checking account, but they're going to want your 401k plan document and an EIN for the 401k. Now, a lot of people in the solo 401k industry, typically like the broker dealer, it's like if you have a solo 401k at Charles Schwab, which is fine. Lots of people do that. They just want to buy stocks and stuff. They don't get an EIN for you. They just set up a plan for you. Now you're captive to just staying at Charles Schwab, but they don't get an EIN because they know it's a 401k and they're not going to do tax reporting. But when you're self-directing, you need an EIN. You're going to go buy real estate in your 401k's name. I don't want you using your EIN that is your business, because that 1099 when you sell the property or whatever tax reporting happens, that's going to go to your business. And now the IRS is expecting this to be on your business return. Okay. We're going to get a separate EIN in the 401k's name. So it's clear that when you get tax reporting for a real estate deal, any self-directed deal, a K1, whatever may be coming from your self-directed investments, it's going to your 401k. So we get separated from your personal stuff, not taxable.
I love it. Now, let me throw out one. I don't know if, Matt, this was on your list, but one of the landmines is, for some reason, people think, oh, I got a solo 401k and I'm self-directing. I'm special. I don't have to follow prohibited transaction rules. Bullcrap. Sorry, I had a cough there. Was that in the mic? Sorry.
Yeah.
Okay, so here's the thing, everybody. You follow the same damn rules of self-directing your IRA that you do when you self-direct a 401k. Same rules. So don't think you can get around, oh, well, I'll hire myself, or I can hire my other company to do the rehab on my fix and flip in my 401k. I mean, the list goes on. And we have prior podcasts on this. Go back and learn the prohibited transaction rules. Make sure you got a copy of Matt Sorensen's book. I'm holding it up on the screen here. Matt will buy me later.
A 50 plus page chapter on the solo case specifically.
I love it. Now, yes, you can get around what's called UDFI, unrelated debt finance income, which is one perk of the solo 401k when it comes to investing. But other than that, you're following the same dang rules. When it comes to investing. So
the solo K, the solo K does have a benefit on UDFI on leveraged real estate only. But let me just say, I see ads for people doing solo Ks. I see websites. I can go to one right now of these online places that do it, that have zero credentials, that say no UBIT in solo 401ks. And they talk about how you can flip properties and not pay a UBIT. Nope, it's wrong. This is why people go to school. You know, this is like the person playing doctor telling you to take this when it's not what you're supposed to take, or do this when it's not what you're supposed to do. They don't know. And they're trying to sell you something. UBIT applies. The only difference is UDFI on leveraged real estate is exempt. And I'm the one that found that exemption and started talking about this in the first place. I heard no one talking about that until I had a client that I had a deal on leveraged real estate where we found this exemption. I put in my book, I started talking about this. Well, people have blown it up to be like, no UBIT. No. Or sometimes people would say no UDFI period. No, there's still UDFI, just not on leveraged real estate. No. So you just got to be careful on some of these things. That's a common misnomer. And the reason why people think that is that's what they're told.
Yeah, I love it. I'm thinking of Catch Me If You Can with
Leonardo DiCaprio. Love that.
Yeah. Show. I love it. Do you concur, Doctor? Doctor, do you concur?
Yeah, where he's pretending to be the doctor, and he just kind of walks in and agrees with everybody.
Yeah, I love it. A true story, which is fascinating if you haven't watched that, people. But yeah, you play doctor like Leonardo DiCaprio in that movie, Catch Me If You Can. Excellent movie. And that's what a lot of these 401k salesmen are doing out there. They're trying to play lawyer and play accountant rather than getting licensed, which is regrettable. Okay, same prohibited transaction rules. Any other landmines, mistakes people make that you want to mention?
Yeah, here's a big one. And is people fail to properly report contributions and rollovers. Okay. When you're using an IRA custodian, let's say you're using directed IRA, we're kind of handling it for you. And we have staff that do this all day, so it doesn't get screwed up. But in a solo K, a lot of solo K owners, again, they self-trustee it. They don't want it to be a custodial account with us. They want to do it themselves. Okay. Well, let me go over two critical areas that are always, not always, but are many times screwed up. The first, if you're rolling over funds, let's say you've got an old employer 401k or an old IRA, you're rolling into your new solo K, that's great. You can do that. Make sure that prior place knows where this money is going as a retirement account, because they will code the 1099-R that's going to get issued and go to you personally. They're going to code it with the code G in box 7, which basically means to the IRS, hey, this person took a distribution of their retirement account, but it got immediately rolled over to another qualifying retirement account. And so it's not taxable. Now, if you don't do that right, what happens is you get a 1099-R without that code G. It just looks like you took the cash, and the IRS is going to start trying to collect from you. So that's the first one, is make sure you're doing the rollovers properly. It's typically called a direct rollover because it's coming from a 401k or another IRA to another 401k.
Okay. I'll talk about contributions in a minute. Keep going.
Okay. That was the next one, was the contributions, and making sure those are properly tracked.
Just one example on this is I've had a client a couple times over the last 3 years that set up a solo 401k and was so excited. And then, some of you people out there are kind of this way. You just think it automatically happens. You think, I set up the solo 401k and I'm going to do these kick butt contributions, and it just somehow happens out of thin air. And it's a common mistake because people that go work for a big company and they sign up for the 401k, it really just kind of happens automatically. And they don't realize the mechanism and machine behind these big companies in these 401k plans, where there's pre-programmed processes when your W-2's issued or your paycheck every 2 weeks. It's done for you. But so people think it's that easy. It's easy when you have a solo 401k if you freaking follow the steps. So these clients call up later in the year and go, hey, I got my contribution for last year done, right? It's on my tax return. Whoa. Did we put that on your W-2 in January? Well, I don't know. Doesn't that just happen? I did a solo 401k. Well, we didn't. Did you communicate to us what you were doing? Did you tell your payroll company? Did the contribution get indicated on your W-2 in January? Even though the cool part is you don't have to put the money in until I have clients putting money into their 401k now in the middle of 2022 and getting a write-off for 2021. That's fine. Yeah. If you put it on the W-2 in January. If you didn't, you are jacked up. So have to be engaged. And it's okay. You're going to save thousands in taxes. Pay your damn accountant, pay us, your lawyer, to do it right.
Yeah. So this is the solo 401k. This is, yes, it's awesome, but with all this power that you get with a solo 401k comes some responsibility. All right. you gotta be tracking this stuff and letting your professionals know. And so on the other side of that, with the employee contributions on the W-2, the employer contributions are going to go on your company tax return. So if you're an S Corp, this is going on line 17 of your S Corp of employer retirement plan contributions. This is an expense on your employer tax return. And if you're a sole prop, it goes on line 28 of your 1040. And so these contributions need to be tracked. Make sure you know what to do. Now, it's not overcomplicated because you're going to be doing the same thing every year. You're just going to get in the rhythm of it. But when you're new to this, don't forget these contributions have to be tracked. And a lot of people skip this. They get excited. They want the tax deductions. And then they come doing their tax returns like, how come I didn't get a deduction for this? For what? I made a contribution. News to me.
Yeah.
Okay.
Yeah. And I think the sub point there is, I would say, even if you use one of these online sites or have previously, even if you've used us at the law firm, or plan to, there's a key person in this mix that you have to keep in the loop, and that's your CPA. We've got our sister company, Kohler & Air, and the accountants over there get so upset when the client has come through the law firm. We set up the solo 401k, we guide them through it, and they do everything. But then they don't tell anybody. They think we're talking about them at the water cooler. We're not.
Yeah.
You've got to go when you do your CPA intake process, wherever your CPA is at. And this is not an H&R Block on a weekend while your spouse runs down to Starbucks and gets you a latte. This is a very comprehensive intake when you're meeting with your CPA and say, by the way, I set up a 401k this last year. Here's what I've been doing. Here's the numbers. And your CPA is going to go, oh, well, wish you would have told me sooner. And so we want you to alert your tax professionals right away. And if you haven't, do it now. Get everybody on notice that this is what you're trying to do so they can help you.
Yep, love it. Okay, one other final reminder here is, remember, this is just for those listening to this right now, 2022, the 5,500 is due July 31st every year for the prior year. It's a $25 daily penalty for being late that maxes out at $15,000 per year. So you don't want to miss it. Make sure you're getting those filed on time. A couple other scenarios where you need to file a 5,500, even if you don't have 250,000 of assets, is if you close out the plan. If you've closed a solo 401k plan, even if it was below 250,000 of assets, you also need to file a 5,500.
Now, I will throw out a couple details we wanted this to be evergreen, but it's important you know this. This year, July 31st is on a Sunday. So if you're using your Mark J. Kohler handy dandy calendar, which you can still get at markjkohler.com, we have all the deadlines in there. August 1st, which is a Monday, is when your 5,500 EZ is actually due this year. You can file an extension.
Yes.
And the extension is essentially a 2-month extension, 2.5 months. And that's form, I don't wear my glasses today, 5558. So you can file an extension, 5558, and then your 5500 is due on October 17th this year, because the 15th is on a Saturday. And then you can buy yourself 2.5 months to get it done.
Yeah.
Sometimes clients are still figuring out how much their match is going to be in their solo for the prior year. You've already nailed down, like I said, on your W-2 back in January, your initial contribution. But then you're going to say, oh, I've got until September 15th to file my S Corp or my sole proprietorship. I have until October 17th. So you've got time to figure out what's that match going to be.
Yeah.
And so you can file an extension, be aware and communicate now. And we have our services to help you get it done. Just let us know you're in the system and in the pipeline so we don't miss it.
Yep. All right. Well, I hope that helps. Making sure you avoid any problems. Those of you that have solo 401ks or QRP, whatever you love to call it, hopefully that helps you avoid some of the landmines and common problems people make. And of course, if you need help, you got your plans jacked up, you need to restate it to the right plan, get it up to date. We have the restatement at KQS Lawyers where we'll restate your existing 401k plan onto our documents that are compliant and up to date. And of course, we can help you with your 5500s. Let us know if we can be a resource to you. And then, of course, stay calm and self-direct on.
Great. I couldn't take us out any better. Good job, Matt Sorensen. See you next week, folks.